At certain times, investors want market exposure, whereas at other times, protection is more important. A Target Volatility Controlled Index adjusts for the level of market exposure that an investor is exposed to, dependent on the volatility in the market. Now, certainly history suggests that there is an inverse relationship between market performance and market volatility. A very good evening to you, gentlemen. Let's kick off with the topic. Lawrence, I'll start with you. Let's look at emerging markets and the kind of attractiveness of them from a Barclays Capital point of view. Are you becoming more and more focused on the growth that you're seeing in emerging markets?
Yes, thank you very much. Well, I think certainly emerging markets are an attractive place. You know, if you just roll back the clock to a couple of years ago, certainly in the mid-90s, you had emerging markets being spoken of as the problem child. You had the Argentinian and the Russian crises in the late 90s. Whereas now we see emerging markets being spoken of as safe havens. That coupled with the expected growth prospects make them very attractive investment opportunities.
Is it safe haven? Are we at that point right now where we're actually looking at emerging markets being classified in the safe haven pool?
You know, I certainly think we're at the cusp of that.
Okay.
You look where we are, you know, you see in Europe there's tremendous problems with their debt. And then you look at the emerging markets, they've got tremendous surpluses. So you know, we're probably not at that stage, but we're certainly at the inception, a tipping point where this could be the case. And
certainly growth is very attractive right now. Even just looking at some of the numbers that have come through in terms of growth forecasts, very attractive.
Yeah, I mean, in the absence of growth out of the Western world, you're kind of sitting with an emerging market block where people are starting to say, well, listen, maybe we should take this a lot more seriously. And certainly, I mean, the numbers certainly substantiate that. I mean, if you look at just look at your screen at the moment, and you'll see some of the growth forecasts. And this all the charts today come courtesy of Barclays Capital. And there you can see the developed world and BRIC GDP growth numbers that you see for 2011, 2012, and the forecast for 2013. And as a matter of fact, if I just show you the next graph over there, you'll see China, India, Brazil, and Saudi Arabia, and you see their demand for oil and how that looks relative to the rest of the world. And you can see that those obviously make up a far larger portion. And that's just kind of some of the telltale signs. And hence, Western investors are sitting looking at emerging markets and saying, well, how do I get exposure to this? I don't want to get burnt, but I need exposure to this, especially from a global portfolio construction perspective.
Okay, so I see you're using an iPad to show us those graphs, and we know that Apple, for example, recently reported results. They sold 35.1 million iPhones in Q1, and the large chunk of the sales came from China. And so that really is an illustration of where earnings are coming from for companies that are based in America right now. Is that something that you take notice of?
I think the interesting thing is that emerging markets in the past are very much commodity focused, and I think we are leaving that kind of era where corporates and countries like India are actually diversifying into manufacturing and other sources of growth, and a lot of that growth, I think, going forward that we saw earlier on will be a much more diversified kind of stream that makes emerging market growth more stable and more sustainable. Obviously, developed markets are a key area for emerging markets to export to, and emerging markets are very dependent on what's happening in Europe and also China to some extent. So there is risk there, but the growth is becoming more diversified away from resources.
As you say, there is that dependency that emerging markets still have on growth from the developed world, but there's a lot of volatility that still comes with investing in emerging markets. Just looking at one of the highly traded ETFs from emerging markets, the MSCI Brazil ETF, on a 3-month return, you're looking at 10.3% up. On a 6-month return, it's down by over 22%. Huge swings in those emerging market ETFs still.
Yes, absolutely. I think investors are, it's the whole concept of greed and fear. They absolutely are greedy because they want to try and get those returns, but also they're fearful of this increased volatility. And recently at Barclays Capital, we've seen tremendous demand for products that control for volatility. This provides stabilized returns and helps investors sleep better. So I think that's why we've seen tremendous uptake in these products that control for volatility.
So see, when you look at the Western world investing into emerging markets, we talk about things in markets called home bias. And home bias means that you want to make sure that the majority of your capital is actually invested on home turf. You understand the companies, you understand the fundamentals, and when you were a US investor in the past, this worked very, very well. Yeah. Now, unfortunately, where's the growth going to come from? So you have to be in the emerging market space. Now, if you speak to the average Western investor, he'll say to you, well, listen here, there was an emerging market crisis not so long ago, and I can remember what happened there. You know, so quite frankly, from a sentiment perspective, it's quite difficult for them to invest. And I mean, this is the debate we'll have a little bit later on around kind of TVCI, which is which is these Target Volatility Controlled Indices. Let me just clarify that. But is how do you control for this? Is there a way that you could potentially control for this, but still get the exposure, which I think is kind of the important things to kind of consider here.
As you say, strong demand coming through for these kind of products. But firstly, let's take a look at the type of returns we've seen from emerging markets, because a very different story, Kirby, up to 2000 and then beyond from 2000 to where we stand right now in terms of returns.
Yeah, I mean, look at your look at the graph that's on screen at the moment, and you'll see the performance of the MSCI Emerging Markets Index relative to the MSCI World Index. And this now chart takes you up to 2000. So this is from 1990 to 2000. So certainly there were periods that you could have benefited being in the emerging market index with a lot more volatility, but having been invested in the world index, which is predominantly much more focused on kind of those global companies, you would have seen a very, very different return and a higher return. But that's now changed. Look at that over there. This is now from 2000 to 2012. And you see a lot more returns coming out of the MSCI Emerging Markets Index than it does out of the World Index. Now, obviously, MSCI Emerging Market Index, there's obviously kind of sway towards BRIC, which is Brazil, Russia, India, China. You know, so you're seeing a lot more of that coming to the foreground. So that environment has changed. And the question now is, how do you harness that?
Yeah.
You know,
but just looking at that graph, though, Roland, there's still that volatility aspect. The returns are a lot higher, but you still see those huge swings, particularly, for example, last year we saw emerging markets underperforming.
Yeah, I mean, we must understand that emerging markets are what are known as a high beta play. So that because they're so dependent on developed markets, they do really well when developed markets are stable, or when developed markets are doing well. Emerging markets outperform. But equally when developed markets are in crisis, and that's what we've been seeing is this risk-on, risk-off kind of trade. So you will see emerging markets underperform seriously because of that higher beta kind of exposure to the growth in developed markets. So it's certainly a volatile game, but that is the challenge, is not to outperform, but to avoid losing money in key periods.
Capital preservation, as always, and perhaps obviously making the type of returns. Before we get into mitigating the downside risk, very quickly before we go to break, what type of demand have you been seeing coming through for emerging markets? Is it emerging markets as kind of a whole body, or are you looking at specific countries as being more attractive on a relative basis?
Or sectors even, yeah.
Yeah.
I think at the moment we've seen a tremendous demand for emerging markets as a whole. Certainly it's been focused around the four big emerging markets, the BRICS, plus the MSCI World.
Is that the BRICS that you said, or the BRIC? Because we know South Africa, of course, is not included.
I think that's a great question, because you know, you see South Africa and the BRICS beginning to flex their muscles. There's talk of cooperation, how to get growth, talk about developing a development bank, but you know, it's a challenge. You know, China trades with these countries tremendously. There's not too much trade between the others. So I think this is a sign of the emerging markets beginning to flex their willpower. They have the FX reserves. They generated 92% of the global growth from the last 2 years. So they're coming to the fore, and they're beginning to try and influence the world according to their agenda.